The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to BMA's July webinar, which is about lean financial thinking. My name is Nick Katko, Senior Consultant with BMA, and we're going to spend the next hour talking about how we change our thinking about financials in financial analysis and management in lean organizations. First, a few housekeeping items, and I would appreciate if you would, in the question box, I want to make sure, can everyone hear me? Can everyone see me? Please just either in the chat panel or in the question panel, just say, yes, you can. Okay, so yes, you can hear me and see me. Great. Thank you very much. I just wanted to confirm that. Okay, we're going to start the webinar here in a minute. If you have any questions, please type them into the question panel on your control panel, and we will answer questions at the end as much time as possible. Secondly, if you would like a handout, a copy of the presentation, if you look in the handout panel, you'll see the PowerPoint presentation, Lean Financial Thinking 2018. You can download that into your computer for your use. Finally, at the end of this webinar, I will create the recording, and tomorrow, about 24 hours after the webinar, you will get an email thanking you for attending the webinar with a link to the recording, which is for unlimited time, and you can share that link with anyone else in your organization or outside of your organization. And for those people who cannot attend the webinar, they will also receive a link to the recording. So if there are no other questions, which I don't see, we will get started. Okay, great. So today we're going to talk about lean financial thinking. Over the years, I've been very lucky to be involved in lean accounting for 25 to 30 years. And my thoughts on where do you start with lean accounting? Traditionally, it's about, well, put the practices and tools in place. But the more that I've evolved my thinking or my thought process, it's really about changing thinking. And that really is the first step in a lean accounting journey, is to change thinking. Yes, the tools and the practices and methods of lean accounting are very, very important, but they only make sense to an organization if the organization is thinking a certain way about lean and the role of lean accounting. So today what we're going to do is we're going to be talking about how do we understand the financial impact of a lean business strategy? How do we change the thinking in accounting? And this is inside the accounting function. It's not that we're thinking wrong, but it's how do we change our thinking so that we are aligned with a lean organization. Then we're going to talk about how does the organization change its financial thinking. And this really is about sort of certain aspects of numbers which appear to be true in a traditional thinking organization, but when you look at it from a lean viewpoint, those assumptions are no longer hold, and so we're going to review those. And then we'll wrap up and we'll have some questions. So the first part is the financial impact of a lean strategy. What I'd like to start out with saying here is that there needs to be consensus throughout the entire organization about the financial impact of a lean strategy. There's lots of information about what lean does organizationally in terms of change and improvement, strategy, all of that. And I'm not really going to spend much time on that. But where I think there needs to be a better agreement in an organization is, what does lean do financially and how does lean work financially? Because it's a lot different than other business strategies. And let me explain why. Lean is really about learning. It's about people learning about their work and getting better at doing their work. It's about finding the right problems to solve. It's about people having the capabilities to solve the problems. It's about people having the ability to analyze problems in what is called changing context, which means whatever's going on today, how do I analyze this problem? Because it might be a little bit different. The context today might be a little bit different than last week or last month whenever we looked at this problem. In general, what we're trying to accomplish is to get an organization to do things tomorrow that it cannot do today. And this is about learning. This is one of the reasons why lean is very much a long-term strategy. It takes time to learn, and also learning never ends. We as humans, whether we're in school as children or adults, we continue to learn. And what we want to do is take this organization, this business that we're in, and think of it as we need to, as an organization, begin to learn. The result of all this learning is what is, from a financial viewpoint, is a financial growth strategy. What happens? We eliminate waste. All of this learning and problem solving results in eliminating waste. What happens when we eliminate waste? We create capacity. This is the idea of creating time. And the creation of this capacity, we use it to create a competitive advantage. We serve our customers better tomorrow than we did today. We build this competitive advantage because we're serving our customers better than our competition. This allows us to sell more products or deliver more services, which results in revenue growth. So the primary outcome of lean from a financial viewpoint is the growth in revenue. It is not about cost cutting. There's a lot of people out there that think that through the application of lean practices, you're going to make significant reductions in your costs. And that's typically not true. You will do a better job of controlling costs, but it's not just a cost-cutting exercise. The easiest way to explain lean is what I call the economics of lean. And we think about basic economics 101, supply and demand. On the demand side, we increase demand by delivering value and creating this competitive advantage. And we experience better revenue growth than in the past, our historical averages, and better than our competition. We take market share away. On the supply side, think of the supply of your resources. These are the people and the machines that are actually creating the value. Through the application of continuous improvement practices, This is what controls your costs. So you really manage your growth rate in costs. Way back when, my first exposure to lean as a chief financial officer, this is what I experienced, and I'm very fortunate to have experienced this early in my career because it really shaped the way I think about lean and what it means. Is that the company that I work for, we put lean practices in place, followed the standard practices, and all of a sudden our revenue was growing as opposed to 5 to 7% annual revenue growth. We were up in the 20% annual growth range. Our costs were like maybe in the 5 to 7% growth range. And so if your revenue is growing at 20%, your costs are growing at 5 to 7%, in the long run, you will make more money. But the benefits, the financial benefits of lean are not direct, nor are they immediate. Now, this is counter to business thinking, because in most businesses, most for-profit businesses, it's about, how did we do last month? How can we get better next month? How can we get better next year? So there's a lot of short-term thinking. And there's also this idea that, well, whatever we do, we should see the financial results very quickly. And so, again, this is a change in thinking. And so an organization has to make a commitment to the lean strategy. We have to learn and solve problems. And as I mentioned earlier, learning takes time and solving problems takes time. What we end up creating is time. And in a lean organization, time is the most important asset. We use that time that we create to deliver value, and only until we deliver the value do we see the financial success. So we want to be lean. We don't want to just do lean. Doing lean implies that we're just doing a lot of things and seeing a lot of results. Being lean is almost like a state of mind, and it's a long-term commitment to the strategy, and that we're not going to take shortcuts to being lean. We're going to learn, we're going to solve problems, and we're going to do this in a very methodical manner. So it's very important for an organization to understand that the financial benefits of lean are not going to be very immediate, the long term. What does this look like on a graph? Well, on the left side, you see maybe what I would call your traditional strategy, business strategies, where you have, a nice steady revenue growth and your costs are going up. And yeah, you make money and you make more profit over time. The lean strategy, what you see if you compare the graph on the right to the graph on the left, is that the angle of the revenue line gets steeper and the angle of the cost line is flatter. So you can see over time that you make much more money than in traditional strategies. What I like to tell organizations, especially financial people, is that it's very easy to model this for your business. Double your growth rate in revenue. Keep your overall cost growth rate at a lower percentage, 5-7% a year, and model this over 10, 15, 5, 10, 15, 20 years. And you can demonstrate to people what the power of lean is financially. So this is at a macro level. At a micro level, here's a very simple example of how lean works. So let's say we have a value stream that currently sells 1,000 units a month at 200. We make revenue of 200,000. We have material cost of 120. We have actual production costs of 60, and we make 20,000 in profit. 10% return, that's pretty good. Used through the application of all the different lean practices and methods, 20% more capacity is created in this value stream. So the question is, what's the cost of selling an additional 200 units, and how much money do we make? And this really shows the power of the economics of lean, in that the revenue and the material costs go up because we are producing and selling 200 more units a month. The production costs, however, remain the same because we are creating the capacity. So we're not buying the capacity, we're creating it. So what we end up with is a 20% increase in profits. I'm sorry, a 20% increase in revenue, but an 80% increase in profits or cash. This is sort of the financial leverage of lean, in that you get a whole lot more profitability out of this effort that you put in to eliminate waste and create capacity. And again, this is a very simple model which can be used in any business to explain what happens with lean. And it's really important for the entire organization to understand the economics of lean. So that wraps up sort of the financial piece of how the lean business strategy. What I wanted to do now was shift over to the accounting function, and how, as a whole, we need to change our thinking. A lot of this is based on personal experience, that me as a chief financial officer experiencing a lean transformation. But also I've seen it in a lot of companies that I've worked with, and I also have not seen it in a lot of companies that I've worked with. Traditional financial accounting thinking is really sort of looking backwards. There's how did we achieve the financial results? We analyze the financial statements. We ask operations. We ask the rest of the organization, well, what happened that caused these financial results? We do a lot of projections about what we need the numbers to be. And then what I like to call financial engineering is that we sort of, from a top-down viewpoint, we sort of say, here's what needs to happen. We need to control our costs better, which means we may have to cut our costs across the board by 5 or 10%. We might have to raise our prices. We might have to do some other things that help us achieve the financial results that we want. And again, this is all from achieving the numbers that we want to achieve. And what I like to say is that we need to be thinking more forward-looking rather than backwards-looking, and we need to have a better understanding of operations. And from this is where we start understanding the difference between financial thinking, financial accounting thinking, and lean thinking. Lean thinking in general is, what is our current performance? What are the problems and issues that we identify today that are the root causes of us preventing us from improving our performance? We drive actual physical actions and physical improvements to change operations. We permanently solve problems, and we create sustained improved performance. So we have to know what are the problems today to make tomorrow better. And we need to actually take the actions. And this is the one reason, if I go back one slide, This is one of the reasons I think I've seen in organizations where in a lean organization where accounting and operations really don't understand each other, because you have accounting thinking like this, and then you have lean operations thinking like that. So we need to change our thinking, what I call lean financial thinking, about solving tomorrow's financial problems. So we need to understand our current financial performance, but we need to understand it based on the root causes of macro operational problems. What are the primary operational issues that are preventing us from performing financially better? And this is not just that, what's the budget? It's about actual performance in terms of serving our customers. It's about understanding productivity so that we are eliminating non-value added work. And again, we need to focus on solving these macro operational problems. As a result, we deliver value, we improve productivity, and we create the sustained financial improvement. And we need to build a very strong link between lean performance and financial results through understanding the economics of lean. And if you look back on a lot of these slides, you can almost see that I'm repeating myself. Meaning lean is a learning system about solving problems and having the capabilities to solve problems, the elimination of waste, the creation of the capacity, the economics of lean. And this is the way we need to think in accounting. Now, I do want to say one thing here. Analyzing last month's performance to report to shareholders and other readers of the financial information is still a necessary and vital function, but it's not the only function. And looking forward is not just an Excel spreadsheet exercise, meaning, well, here's what the numbers are. We run some Excel spreadsheet and we say, well, here's what the numbers need to be, and go make the numbers. It's about understanding operational problems, and it's really about spending more time on that data and what the impact of changing operational problems is on the financial results. We also need to think about the role of management accounting. And there's an article that the Chartered Global Management Association put out a few years ago about the role of management accounting. And the role of management accounting is really a link between the strategy of a company and sort of the business operating model of the company. So one necessary change in thinking in accounting is that the management accounting system must change for a lean organization. Why is that? Well, we have a lean strategy, people, value, and processes. We have a lean business model about thinking and learning and flow and pull and improvement. And so our strategy changes, our business model has changed. So now what we have to do is create a lean management accounting system. So for those of you who are not that familiar with lean accounting, when you hear lean people talk about lean accounting, this is what they're saying. They're saying that they need a management accounting system that is applicable to the lean strategy and the lean business model. When you hear people like Ori Fumi, Gene Cunningham, and Jerry Solomon talk about lean accounting, this is what they're talking about. And it is necessary and required that the management accounting system must change. In order to do that, the accounting function must lead the change to create a lean management accounting system. We also need to redefine what accounting means in a lean organization. Because when we think about accounting, we think about these people that sit in the accounting department and they're financial experts. They're maybe certified public accountants, certified chartered accountants. They understand the numbers inside out. We produce the financial statements. I looked up the definition of accounting and on the internet, and you can find lots of different definitions, but this one really stood out, is that accounting is about recording the economic activity of an organization. And when you think of accounting this way, there's a lot of people in a lean organization that are recording economic activity. So we have to think of accounting in different cycles. Daily operational accounting, understanding operational performance, and the problem solving and problem prevention that goes along with understanding operational performance. Daily operational performance. Did we achieve our production schedule for today? Yes or no? That's economic activity on a daily basis. That economic activity in the long run will produce financial results. So we have people in a lean organization that are performing daily operational accounting. We also have weekly accounting, and this is at the value stream level, where you have value stream teams looking at the box score, performance measurements, value stream capacity, value stream profitability. So again, we have another cycle of accounting going on about understanding economic activity. Then we have our traditional monthly financial accounting cycle where we're producing the financial statements. So in terms of changing thinking, we have to understand that there's a lot of different accounting activity going on in a lean organization. It's not just about producing the financial statements. So now let's move on to changing organizational thinking. And this is where we have to break certain assumptions about finances in general and financial results in general, because the lean strategy changes the way the organization operates. The first assumption that needs to be changed is, how do we make money? And with a lean strategy, it's very simple, is that the rate of flow will dictate your rate of profitability. So if you want to improve your profitability, improve your flow. There's a direct relationship between this. And if you go back to the economics of lean, about eliminating waste, creating capacity, well, all of the different lean tools and practices help you create flow. If you eliminate waste, you improve flow, and you will improve profitability primarily through revenue growth. You will also become a low-cost producer. Every company wants to be the low-cost producer in their industry, and you do that by managing and improving flow. And focusing on flow does create the long-term profitable growth. So from a strategic viewpoint, as opposed to focusing on financial goals, and don't tell me, please don't take this the wrong way. You still should have financial goals in your organization, but you should have flow improvement goals. And that's what you get that's what you get your non-financial people focused on, is how do we improve flow throughout the organization. So this is not just in terms of delivering a product or delivering a service. How do we improve flow in all administrative processes? Because improving flow means you're reducing waste, which means you are becoming more productive. The second assumption that we want to adjust in the organization is, what is an asset? So the definition of what are your assets, what are your most important assets? An asset is something that is a resource that can be expressed in dollars and produces value. And the value that it produces, or the economic benefit that the asset produces, creates utility over multiple accounting periods, over a long period of time. When you look up the definition of an asset, if it doesn't produce that utility over multiple accounting periods, then it's an expense. So if I were to create a lean balance sheet, and again, this is just sort of something I've been thinking about, people and time are the most important assets in a lean company. What do we do with people today? The salaries and expenses. We expense them as if there is no utility over multiple accounting periods. But people, being the most important assets, they think, they learn, people create the value. Now, yes, you might have machines also, if you're in manufacturing, that create value. They're already capitalized. So if you were to create a lean balance sheet, you'd have people as your primary asset. Time is the second most important asset. So even though we expense our salaries and wages, we can't think of it from a strategic standpoint as an expense. We have to think of it as an asset. What do we do with our machines? With our machines, we have maintenance, we have planned downtime. We're constantly watching our machines to make sure that they're set up right and performing right. And we need to do that with our people too. And I'm not saying people are machines, don't get me wrong, but people have to learn. They have to be able to solve problems. People have to perform. They have to be given good performance conditions to perform properly. So we wouldn't even think of overworking a machine. If you run your machine greater than what the manufacturer says, it's going to break down. But yet we work our people to death in terms of overtime, in terms of adding more responsibilities. And what happens? People break down. So we have to rethink about our assets. So now let's look at some other aspects of changing financial thinking. Labor. And traditional thinking, which I've sort of just explained, is that our labor is an expense that needs to be managed. We have to be very cognizant or concerned about headcount because that increases our expense. And while that's the way we record labor from a financial accounting viewpoint, from a lean viewpoint, people are our most important asset and productivity matters. So in terms of changing financial thinking, we have to be concerned about the productivity of our people, not just the expense. And in my book, The Lean CFO, I even have a little section where productivity matters, headcount doesn't. What I like to say is it doesn't matter how many people you have if you maintain and improve your productivity rates. Because productivity means you're getting work out the door, products or services. The second myth that we want to break is time and costs. Traditional thinking, excuse me for a minute, I just want to take a sip of water. Traditional thinking is that the longer production time for a product or a service, the higher the costs. That is really not true. What we're concerned about, and yes, certain products or services take longer than others to make. If you're creating value and you have a complex product, well, it's probably going to take longer to make, but that's okay. What we want to do is, when we think about time, is it's our second most important asset, and we want to maximize the value added time that we spend in the organization. Because if we spend time on non-value added work, that's waste. And that may extend a production time or delivery time for a service. So time is an asset. We want to maximize the value added time. And we have to stop thinking that more time creates more costs. Our overhead costs, which are all these other expenses which occur in the business. We like to spend a lot of time allocating these costs to understand the true cost of operations. What we want to do from a lean viewpoint is analyze the root cause of our spending habits. The spending decision is what creates the cost. So where is the spending decision occurring? That is not done through cost allocation. That is done by identifying costs where and assigning costs where the spending decision occurs, and then being able to do a good root cause analysis on the operating reasons why we're spending what we're spending. So again, we have to change our thinking. Financial goals. Traditional thinking is, make the financial plan and do what you have to do to make the financial plan. The fact of the matter is that many financial plans are based on a lot of assumptions, and not all of those assumptions hold. What we want to do is focus on making the flow improvement plan. If we focus on improving flow, we know, based on the economics of lean, that we will improve financially. Now, those financial results may not be direct, nor may they be immediate, but we need to have that lean financial thinking principle ingrained in the organization, that we will achieve financial success if we work on improving flow. Now, this doesn't mean that we don't do financial plans. We would like to have the financial plans linked to a flow improvement plan. Managing costs. Traditionally, we focus on actual to budget analysis. Make the budget, and if you don't make the budget, why didn't you make the budget? And by golly, you need to figure out a way to make your budget in the future periods, or cut your costs to get your year-to-date budget in line. Budgets are very static. We set an annual budget, maybe we change it to a forecast, a monthly forecast, but again, it's fairly static. What we want to do as an organization is understand the dynamic relationships between performance capacity and costs in the context of how our business is operating today and how it can operate tomorrow. And finally, understanding profitability. We like to slice and dice the business up by customer, by segment, by business unit, by product, by service, to understand profitability. And really what we're trying to do is drive some level of root cause analysis, but most of this type of analysis is done from the top down, and it's more of a financial exercise. Value streams are the profit centers of a lean organization. So what we want to do is focus our effort on understanding our value streams, how they operate, what the problems and issues are, and how do we improve the flow in each value stream. Value streams are different. They're not the same. Different products, different services, maybe different customers, different problems and issues, different resources. So we have to break our business down by value stream, understand from a financial viewpoint that they are the profit centers, and that's about as low as we need to go in terms of analyzing profitability. So that wraps up the financial thinking that we have to change in the organization. So let's just do a few summary slides and then we'll get to some questions. What we're really trying to create is a lean financial learning system. Much like lean is a learning system for people about operational type problems and issues, we want to create a financial learning system. So we need integrated measurements to understand the dynamic relationships between the strategy of the business operations and the financial numbers. So we need the right types of measures in place. We need to create good financial management analysis based on the economics of lean, and we want that to be used by the entire organization. All the financial management occurs throughout the organization, not just in the accounting function. So we want all financial analysis to be aligned around the economics of lean and to be used consistently. And finally, the financial impact of lean. There needs to be organizational consensus around understanding that what flow does to profitability, the financial impact of improvement, and also the rate of improvement necessary from a strategic standpoint to achieve financial goals. How much, that's sort of the top down, that if we want to achieve certain financial goals, how much improvement do we have to make to deliver the value, to grow the revenue, to control our costs better? Now the organization needs to learn about how lean works financially. It takes time to learn. And lean takes time also to put in place and to become a robust system. So this idea of learning is that we're in this together. We're going to be thinking about lean from a long-term financial viewpoint, not just short-term, monthly or quarterly goals. Secondly, we have these dynamic relationships between operating performance, capacity, and financial performance. They need to be understood clearly and consistently and uniformly throughout the organization. We understand our current state. What is our future state? What do we want in all three dimensions here? How do we get there? How do we change operating performance to improve financial performance? How do we improve capacity to improve operating performance to improve financial performance? And whether we're looking at something from a strategic standpoint or we're looking at a specific decision, we need to understand these relationships, and they need to be used consistently throughout the organization. And finally, we need integrated organizational thinking from a lean viewpoint. We have, from a lean financial viewpoint, we have the lean strategy. We have our daily accounting, our weekly accounting. We have financial management practices, and we have financial performance. So we have like 5 dimensions here of thinking that all need to be aligned. You create this alignment by changing your management accounting system. If you don't change the if you don't change the management accounting system, it's very difficult to create the alignment in these 5 dimensions. And when we think about financials and financial performance, Another shift in thinking is about thinking about the flow of money. In lean, we talk about order flow. You know, how long does it take to process an order to deliver a product or a service? We try to shrink that time frame. Also, when you hear about order flow, you hear about information flow. Well, lean accounting is really about accounting for the flow of money. Now, when we think about lean accounting, we have to think about internal customers. And most of these internal customers are non-financial people. So we're trying to create a good management accounting system that shows the flow of money in terms of revenues and expenses and the financial management and the analysis. Because if we, much like if we maximize, I'm sorry, much like if we improve the order flow, we will improve profitability. If we get better with the flow of money, we will see that eventually in our financial results. The reason we want to really focus on the flow of money internally is because external financial reporting requirements sometimes mask the flow of money. And so what this does is this confuses non-financial people. And again, I'm talking about internal use only. External financial statements continue to be reported the way you normally report them according to the accounting regulations in your country. But internally, we need to do things differently. So, just to wrap things up, if you think about the 5 principles of lean, there is a corresponding lean accounting principle. So the first principle of lean is customer value. The lean accounting principle is that we have customer value drives a revenue growth strategy. Value streams are the profit centers of the lean business. The third principle of lean is flow and pull. The corresponding lean accounting principle is that the rate of flow will determine your rate of profitability. Pursuing perfection, which is continuous improvement. The corresponding lean accounting principle is in focusing on improvement is what will drive cost management and cost control. And finally, empowering your employees. What we do with lean accounting and changing our financial thinking is that we are delivering useful, actionable information to our internal customers, our employees, in order to drive the financial success of lean. So that wraps things up. And I'm going to take, in a minute, I'll open up the question panel and answer some questions. Here's our website, Maskell.com, for articles, books, and blogs and other information. If you'd like to contact me, here's my email address. If you have any interest in receiving our monthly newsletter and understanding when we're going to give future webinars, if you're not already on our mailing list, please send me an email and say, add me to your mailing list. And we have a free lean accounting group on LinkedIn. We have a lot of people in there, and it's a way to understand, it's a way to meet other people who are interested or practicing lean accounting. So I am going to open up the question panel. And I do not see any questions. Well, here's one. Okay, so see the audio. Oh, okay. I see some questions about the audio. I hope you heard me. So the question here from Kirk is, why does lean increase your revenue? Lean increases your revenue by because you are delivering value to your customers. So you have better on-time delivery, you have short lead times, your quality gets better, and if you improve your delivery of value, that is what drives revenue. The second part of the question is, if you are not able to increase your revenue without lowering cost, how does this help? Um, I truly believe that it's about understanding value and what you need to do to drive that revenue growth. I don't really believe that you cannot increase your revenue by delivering value. Um, okay, and I think that is pretty much it. And I see some questions about the broadcast. It's 80% unintelligible, and there were audio problems. I'm terribly sorry about that. Um, you will get a recording of the webinar, and the audio problems will be solved by then. Thanks for attending the webinar, and let me know how the recording goes. And if you have any questions, please ask me again. Thank you very much, and we'll see you soon.